Well, number one, you're going to get inflation. All right. And that's going to be the kicker right there. Do we start to see inflation spiking again? And number two is the Fed's going to have to stop cutting rates, which the market is addicted to that cheap money. And my fear is this, is that you're getting to a point where the debt is going to start to matter. And in fact, I'm short gold right now. Now, please understand, everyone watching at home, I was a bull at the start of the year when we were at 2000. So for me, as a shorter term trade, I'm short gold here for a pullback to 2,500.
Renowned chief market strategist Gareth Soloway has a stark warning. Don't fall for the media's optimism. While headlines celebrate expected rate cuts, Soloway reveals that the Fed is actually bracing for serious economic trouble. With $33 trillion in debt and inflation brewing, we could be facing a crisis similar to the 1970s stagflation. On gold, Soloway predicts a short-term dip to $2,200 before an explosive rise to $3,000 by 2025. The clock is ticking. Want to know how to navigate these turbulent times? Stay tuned for expert insights from Gareth Soloway.
You know, just a couple days ago, the markets were favoring via the Fed watch tool another 50 basis point cut in November. That would be 100 basis points in two consecutive meetings. Yet somehow the spin being put out there in the media is, hey, this is actually great because it means there's no chance of recession. Guys, the Fed is not crazy. They are not cutting that much because everything is okay. If they thought it was going to be a perfect landing, they would do 25 basis points a couple times, then wait a little bit, make sure inflation's not roaring back. They are concerned. Now, the narrative is being spun away from that. Don't get fooled by that spin. Yeah, so I also agree. I think it's very unreliable. I think that for the most part, the markets cue off of what the Fed says, and then they obviously extrapolate out. But to me, you're looking at an economy that is going to slowly weaken, right? If we look at the various metrics here, we have the yield curve has now uninverted. If you look at the yield curve, what happens? It uninverts 3 to 6 months later, we have a recession. And that's been historically the norm. Pretty much even going into COVID, it was briefly inverted just before COVID hit. And so we have to say that, okay, by the end of this year to the first quarter of 2025, that's when your recession hits if you go by the data. And it's very important to go by the data. In addition, if we take a look here, and if I could show my chart, I want to show you the 10-year yield. Look at what we have on this. It's fantastic. So we have gone to a point where we are now coming down on the 10-year, and I have major technical support. Look at this high here, right through these lows, this upsloping trend line. These are merging around 3 to 3.25%. So for me, I'm looking at this is where the Fed funds levels are going to be, where we're going to come down to on interest rates. Now, that kind of puts it in the range, but still, the key to understand here is that we're likely going to see a recession. The Fed is going to want to cut more, but I'm fearful that if they cut too much, it's going to kickstart the inflation gauge again. And I am worried about stagflation. I do think stagflation is a very possible outcome here, not in the near term. No one's going to talk about it for a little while here because we've seen the numbers come down on inflation. PCE came down, CPI's come down. But I do worry that the Fed being so aggressive on these cuts, you're going to see inflation start to move up, but you're not going to see the economic growth that you're hoping to get. Yeah, so number one, we have to look back to the 70s when this happened, right? So in the 70s, this was the last time you saw this kind of stagflation type of focus where we did see inflation moving up even when the economy was slowing. And my fear is this, is that you're getting to a point where the debt is going to start to matter. So you have 33 trillion, 30, whatever it is, trillion dollars in debt now for the US government. The Fed at some point when we get in a recession, they're going to start to make money even easier. And I do worry that these implications are going to force inflation to uptick just a little bit, which is going to basically hogtie the Federal Reserve from continuing to lower rates back to where everyone's hoping. And, mortgage players and interest rates, the thought process is, hey, they could go back to where COVID was, at zero or just around those areas. I don't see that happening. And I do worry that that's going to be the outcome here. We're going to see interest rates coming down, but stopping because inflation begins to kick up again. And then you have a weak economy that can't be stimulated out because inflation is starting to push up. And I think that's right. I think the market is even thinking about, well, maybe we'll go into deflation, right? Because if you look at the PCE data, it's coming down so quickly that, heck, it could be deflationary. I don't buy that. I think we get lower to 2% on inflation, it starts to become stagnant. The Fed starts cutting even more because the economy slows, and that starts to kickstart inflation again, even with a slowing economy. Yeah, so right now the 10-year yield looking like that 3% to 3.25% level. I think that's going to be the key zone right in here. So you're looking at this as being your first major technical support. If it breaks that, then things get really nasty. And what we could look at here is if we zoom out on this chart on the 10-year and go back to 1995, there's a really amazing trend line here. This would be kind of a worst case scenario for yields in terms of downside. Notice again, you have a level here where we take this high, this high, this high, and right through here. And that would be your next target zone of a move to the downside that would take us below. So this is your first target. And then if that breaks, you get here. But I don't anticipate it getting that low. Again, that would be around 2%. That would be kind of a worst case scenario. And I think we'd have to be in a pretty bad recession and not see that inflationary pressure to get yields that low. A safety hedge, you have to be bullish on gold. You have to be bullish on bonds. You have to basically look for these places. Like when you have utilities doing well and defensive names, if the economy starts to tank and we do see any sort of sell-offs in the Walmarts, the money is not going to necessarily choose tech stocks. It's going to still have to be invested, but likely heading to other areas like bonds and gold. Yes, short term it is. And in fact, I'm short gold right now. Now, please understand, everyone watching at home, I was a bull at the start of the year when we were at 2000 on your show. In fact, I said, hey, guys, my target is $2,530. We've gotten there and even gone past it per the analysis. And that was a beautiful trade. Like you said, I was called crazy. As people said, hey, gold is over with. No one wants to be in gold anymore. I love buying things when people say that. So check this out. We have the chart of gold. I'm using a logarithmic chart again. So we look at the logarithmic. We look back to the 1980 high. We connect that to the 2007 bull market high and look at what we just tagged on gold. So for me, as a shorter term trade, I'm short gold here for a pullback to 2,500. At which point I plan to flip it over as my mid to long term remains bullish to 3,000 being hit next year in 2025. So 3,000 target next year, but in the short term, I'm expecting a pullback. And we've actually started to see it. If we flip over to our daily chart, you can see right into that level. Look at that. Beautiful how the charts just work their magic. We're starting to see a pullback. Here's your target zone right here. This is around 2,500. We can see how this was kind of a shelf right here. Then it broke out. We should retrace right back into that level before the next bull move comes in.
Are you looking at potentially $3,000 soon?
Yeah, so I don't think it'll be until 2025, probably mid to late 2025. But yeah, there's really no reason why gold will not go up unless Elon Musk starts mining on asteroids in the near term. That's the only way I would get bearish on gold, because we have to remember that you have debt in the political system, right? The U.S. debt just keeps going up. There's not one candidate for president that's even talking about reducing spending. And remember, when you have a great economy, that's when governments are supposed to pay down the debt because they're bringing in more tax revenue. Instead, our government for a long time now has just been spending. The problem is, if we go into a recession like I think, they're going to need to spend even more to stimulate us out of that recession. I don't even know if it's going to be possible, but you can't go into fiscal austerity when you have a recession. I mean, that's just going to make us go into a depression. And so that debt is going to keep going up. And that's going to make gold a valuable asset to diversify away. And so interestingly enough, and this is really fascinating, is if we get a soft or no landing scenario, which is what the Fed has projected and what many economists have said, well, then it's still very problematic for tech stocks because interest rates won't keep dropping. And even small caps, I mean, the Russell, right? The Russell is trying to push to its all-time highs, hasn't made an all-time high since 2021. But if interest rates are going to stop going down because the economy starts to rev again, well, number one, you're going to get inflation. All right. And that's going to be the kicker right there. Do we start to see inflation spiking again? And number two is the Fed's going to have to stop cutting rates, which the market is addicted to that cheap money. And so it really works both ways. I mean, if we go into a recession, you have valuations because of an earnings recession coming down. And if we have a good economy and interest rates can't fall anymore, the Fed doesn't cut, then you also have that taken away from the markets, the cheap money, and stocks fall. So either way, to me, I'm seeing this market in a very tough conundrum for why this market could continue to go up significantly over the next 6 to 12 months.
Thanks for tuning in. If Gareth Soloway's insights resonated with you, Don't forget to hit the like button and subscribe for more expert analysis on the markets, inflation, and gold. Stay ahead of the curve. Turn on notifications to catch our latest updates. Curious to learn more? Explore our other videos where we dive deeper into navigating these uncertain times. The next big market move is coming. Will you be ready?